Look, I've given myself 15 minutes to cover off the macro, which is not enough time, but I'll have a go and then we'll open up to questions. So just starting with, this is something you'll be able to send around to clients. So I put disclaimers and stuff on it. Why do we look at macro? Why do we care about macro? Why don't we just look at stocks? A lot of people just look at stocks. Don't worry about the macro. Warren Buffett says, don't worry about the macro. It's too hard to predict. This is the reason that you look at the macro. This is the ratio between equity markets and bond markets going back to the 1960s. And you can see a couple of things there. One is that equities mostly outperform bonds. So that ratio is rising from 5 on the left-hand side to almost 30 on the right-hand side. So equities outperform bonds by 6-fold over that period. But there are quite long periods when bonds outperform equities. And if you can get your clients on the right side of that, you can make them a lot of money and save them a lot of money. It isn't obviously easy to do, otherwise we probably wouldn't be here. But that's the whole idea. We look at macros to try and understand this. So if we just think about that global stock bond ratio as something we really want to try and be on the right side of, monetary policy is the key to it. So how do you measure monetary policy? I'm just looking at the US 2 to 10-year bond spread, and I've inverted it on the right-hand side. So you can see that global stock bond ratio does tend to rhyme. It doesn't completely correlate, but it does tend to rhyme with the shape of the US yield curve, which is one measure of monetary policy. So let's talk a little bit about the 2s to 10s. So again, I've inverted it now. So this is the 2-year bond yield in the US, less the 10-year bond yield in the US. So when it's negative, what does that mean? It's a recession indicator, but it's tight monetary policy, right? So you've got short-term rates a long way above long-term rates. It means that monetary policy is restrictive, and it generally means a recession is coming. So this has been negative since sort of middle of last year. That's been negative. So that all other things being equal should keep you cautious. While that yield curve's inverted, it means monetary policy is tight. It means earnings are probably going to be under pressure. So just digging in more to sort of tactical asset allocation and trying to look at some indicators that'll suggest to us where that's going, because it's one thing to say, right, the yields curve inverted, it's tight monetary policy. Is it going to get tighter? Is it going to loosen? What's going to happen? So the things we're looking at here are growth, financial conditions, and central bank policy. And you'll hear me talk about them ad infinitum, because they make a massive difference. If you look at when growth's expanding, you make 10% per annum. If you invest when growth's contracting, you lose 2.5% per annum. And that's over a very long period of time. So the impact on your wealth of those compounding numbers is massive. So composite leading indicators, the OECD just put them out on the weekend for July, and they're all showing improvement. So this is an indicator. If you follow this, you will make money, generally speaking. And there's a couple of observations. Firstly, China's recovered quickly because they've come out of zero COVID. Secondly, the global economy has been in downturn for almost 2 years. So it's not a huge surprise that this is starting to turn around, but this is one positive development that suggests that economic growth is starting to accelerate, and even Australia, which is the green line, which has been pretty moribund, that's started to pick up as well. So that's one green traffic light, if you like, that composite leading indicator is showing a positive. The negative, however, is Purchasing Managers Index, so PMI. So that data there is still trending down. Europe in particular seems to be going backwards at a huge rate of knots, and now we're getting wobbles in China as well. So the manufacturing activity, which is not the whole economy, is trending down. So that's a little bit of a concern. That suggests that tight monetary policy is starting to work on that sector. So growth is a little bit questionable about whether it's improving or whether it's deteriorating. So a little bit murky. Financial conditions is another thing. If you get on the right side of this, you can make a lot of money. So when financial conditions are loosening, you make 12%. When they're tightening, you lose 4%. And again, compounding those numbers over long periods of time is massive. It's a log scale. You can see the difference in the returns. So again, what are financial conditions telling us? Again, very mixed signals. So all through 2021 and 2022, clearly financial conditions were tightening. We went from pretty much free money to having higher interest rates. What I've also put there in the black line is the US 30-year fixed rate mortgage. So Americans have fixed rate mortgages, we have floating rate mortgages, and that's also an indicator of financial conditions. That's continuing to tighten, but more broader measures, things like credit spreads, money moving into the market, that's loosening. So again, a bit of a mixed signal, and you can see that financial conditions loosened significantly when Silicon Valley Bank and Credit Suisse were in trouble, because that was the Fed bailing out the system. So deposits pretty much became guaranteed. That loosened, tightened financial conditions a little bit. They're now loosening again, but again, a bit of a mixed signal on that. Finally, and probably most important, is what is the Fed doing? So if you invest when the Fed is accommodative, you make 13% per annum. If you invest when the Fed is about to tighten, you only make 2% per annum. And again, over long periods of time, those numbers are quite compelling. So where are we now? Now, just on this, I've got unemployment on the x-axis and inflation on y. So I will flip those, so it's a bit confusing. Sorry about that. But where we are now, we've got relatively low unemployment, which is great, but inflation is still a little bit too high. And the FOMC minutes that were released last night talked about how the Fed's concerned that inflation is still too sticky, and they haven't done their job yet to get it down. Does anyone know what the Fed's inflation target is? It's 2%, right? So they're not there yet. They're at 3.5%, and they're not there yet. In Australia, also pretty predictable. We have 5.6% inflation, and as of last month anyway, 3.6% unemployment. Again, does anyone know what the target for the RBA is on inflation? 2 to 3. What about unemployment? Do they have a target for unemployment? 4.5. They don't have a target, but they think above 4.5 is or below 4.5 is inflation accelerating. So they want to get unemployment up to 4.5 and inflation down to 2.3. So they're not there yet. So it suggests that they again stay tight. Now again, if you invest in Australia, when the settings are within the Reserve Bank target, you make about half your return. So capital growth in Australia since the Second World War is about 6%, and 3% of that comes when the RBA's got the settings right. So we're not there yet. We're still tightening in Australia. So where are futures pointing at the moment? You know, these numbers have shifted massively this year. There's been massive volatility in interest rate markets, much higher than equity markets. But right now, everyone's saying they're done. They're at 4.1. There's maybe the market's building in some probability that they go again. But the next rate hike would be 4.35. You can see the orange line is at half of that. So there's a 50% chance of another hike. And that's people like George Thurano at UBS, who's got most of these calls right, saying, look, if the inflation data is a little bit stronger, they will go again. But we think they're done. So that's what the market's saying in Australia. And in the US, they're also saying we're pretty close to done. Again, the Fed futures are at 5.25 to 5.5, the Fed funds rate. So you can see that the market's saying they're pretty much going to stay in that band. They might move them a little bit higher. Again, if we get stronger economic data and stronger inflation, they will go again. So we're not sure that they're done yet, but we're pretty close. And you can see that over the past month or so, that longer end has drifted higher. And that's of concern for investors is long-term interest rates. So as I mentioned, Fed is not done yet, but close to done. It's only really shelter inflation that's holding up. So shelter inflation is running about 7% in the US or 8. But we know from the Zillow rent survey that that's coming down. So that's probably the only thing to get concerned about, is if rents don't come down fast enough. So just in terms of long-term US interest rates, you know, if you look at that slide, you'd say, what's happening to bond yields? If inflation's falling that fast, surely bond yields are rallying, and they're not. And this is a concern. So I've just taken the average yield curve over the last 50 years, which is the red line. So that's what the US yield curve has looked like on average the past 50 years. I look more recently, the last 20 years, it's the grey line. So two things. One, it's upwardly sloping, right, which it should be. You should get paid more to be in the long end than the short end. But also inflation's come down dramatically in the past 50 years, the past 20 years. The market's saying right now that we're inverted. So we've got short-term yields above long-term yields, which is not normal. And secondly, we've also got short-term interest rates that are above the 50-year average. So if you think about that, if long bonds are fair value, then cash rates need to go below 3%. So we're going to go from 5.5 cash rates to 3%, and that whole yield curve will come down. But obviously the concern about inflation is keeping that high, that long end higher, but there's also issuance, which is a problem. So there's an absolute tsunami of US bonds that are being issued. So on the left-hand side is government debt that's been issued. And you can see the debt ceiling was holding in place through the most of this year. And then when the debt ceiling was resolved, $1.5 trillion of bonds got issued. So that's just a massive amount of debt that the market's got to swallow. And secondly, on the right-hand side, the Fed is reducing the size of its balance sheet. It built up almost $9 trillion worth of assets during COVID, and they're quantitative tightening. They want to release that. You can see there was a kink up there. That was them bailing out Silicon Valley Bank. So they flushed the money in the market. They're now reducing it again. So in the past couple of months, we've had almost $1.7 trillion worth of US bonds issued to the market in a market that's about $33 trillion. So it's a big amount of issuance. So the market's choking on that a little bit at the moment. As the pace of that debt issuance slows, which it will do, because most of Biden's spending packages are being done now, we should get some alleviation of that. Just quickly on China, you've heard Heinze talk at infinitum about peak steel in China. He's 100% right. You just look at, crude steel production peaked, 18 months ago, and it came down obviously during the lockdown, but it's not really recovering. So crude steel production is not recovering. That's the black line, and that flows through to the sales of residential buildings. So most steel goes into building houses in China. And obviously there's been a huge speculative boom in housing in China, but we can see sales of residential buildings have fallen dramatically during COVID, and they haven't recovered, and the government's not stimulating the real estate sector. So we can't be too positive on China and its implications for iron ore and other raw materials. And iron ore's been a little bit sticky, but it just seems like a one-way trade. And we can see that credit being provided in the economy is continuing to decline in China. So credit in China is shrinking at 6% per annum. And that's why the economy and some property developers, et cetera, are under pressure. So we can't be too bullish on China. It's not going to save us this time.